San Francisco is done, over, tumbleweed everywhere. Tech layoffs, office vacancies, population headlines, you name it.
2, 1. We put this baby to bed. Shopping is now turned off.
This could be the most serious recession in decades.
San Francisco tends to feel these shocks louder, faster than other cities because everything is concentrated here. Capital, innovation, and media attention. And when something breaks, it breaks publicly. Hi everyone, this is Samantha Huang, founder of NextGen Properties. 精通国语、英语，我会讲中文。Welcome to today's episode of San Francisco's real estate during periods of fear. I've been in San Francisco Bay Area all my life. We've gone through a couple ups and downs of major cycles and mini cycles. So let's talk about what happened in each one of them. We'll touch on it lightly, and if you're interested in more information, of course, give me a call and we could discuss more of what these cycles and what the current market means for you as a buyer, seller, investor. In San Francisco in general, anything that you hear on the news is major. So why the "it's over" narrative keeps on showing up, and what actually happens? Having practiced real estate for over a decade and having grew up in the Bay Area all my life, let's just say I've been around San Francisco Bay Area enough. And you've heard this story before. San Francisco is done, over, tumbleweeds everywhere. And that headline pops up every time there is a disruption. Tech layoffs, office vacancies, population headlines, you name it. This visibility and major headlines in the news instills fear, even if the long-term driver of housing demand has not gone anywhere. And what's really important to understand is that in San Francisco Bay Area, the narrative often moves faster than the reality. Housing supply does not suddenly loosen up. Desirable neighborhoods does not lose their appeal overnight. And economic activity usually reinvents itself inside the city and not anywhere else. That gap between the perception and the fundamentals is where hesitation, opportunity, and mispricing tends to show up. The first major event that's still fresh in our mind, and because we all have relatively short-term memory, is the 2003 dot-com bust.
Amazon.com CEO Jeff Bezos, his company's stock price tumbling from $113 a share to less than $16 today.
The internet moved towards what AOL was doing. So now what is AOL's unique selling point? And are you going to pay $23.95 a month extra for that?
That is a tech crash and not a city collapse. In the early 2000s, the dot-com bust hit San Francisco hard. Startups vanished, venture capital funding dried up, and office demand fell off the cliff. Residential real estate did experience a slowdown, especially at the higher end. And that is because the tech income basically disappeared what feels like overnight.
I feel like my retirement's going up in smoke as we talk here.
At that time, the prevailing belief was that San Francisco had bet too heavily on one industry, and that would suffer a long-term damage.
It's not the kind of stock that you can own and sleep well if you're a small investor.
And what actually happened? Innovation did not leave the Bay Area. It diversified. New tech waves slowly emerged. Biotech, healthcare, finance, and education grew. Housing supply stayed tight. Core neighborhoods stayed desirable. And the buyers who bought during this economy were not betting on a quick rebound of this cycle. They understood the difference between an industry shock versus a geographic one. Now, the one that's more freshly in our mind that happened even more recently and does have something to do with housing directly is the 2008-2011 global financial crisis.
We begin our coverage tonight of what's been called the worst financial crisis in modern times.
3 of the 5 biggest investment banks are gone.
Major sectors of America's financial system are at risk of shutting down.
During this 2008 crisis, there were forced selling. And I'm going to tell you why. This global crisis was different. It wasn't just about buyer and sellers' confidence level in the real estate market. It was about credit and the lack of responsibility to this credit.
Not in generations has Wall Street absorbed the number of body blows it took today. Some call it payback for years of risky lending practices and weak regulation.
financing disappeared. People did lose their homes, and that led to prices falling sharply in San Francisco Bay Area. And that fear was real because often people wanted to act but couldn't. At that time, it felt like the housing market itself was broken.
More than 1,600,000 subprime loans are in foreclosure or in distress.
But what led up to that was a lot of irresponsible lending. 0% down, no income check programs that led to buyers not being able to afford these properties in the long term. And a lot of that has been reorged and adjusted since then. But even then, San Francisco's long-term constraints did not change. Land didn't expand. As you look at San Francisco Bay Area, we're out of places, out of land to really develop. The entitlement is still really hard to get in the city, and the desirability didn't vanish. Once the lending has returned, prices stabilized. And then San Francisco Bay Area recovered faster than any other markets. So that cycle was a reminder that even severe disruptions can feel temporary. And the adjustment periods happened rather quickly. And that leads me to say, we've all heard this saying, you would like to buy real estate and wait for it to appreciate versus wait to buy because of so many other factors. Of course, you have to work with your financial advisor, work with your accountant, work with your real estate professional to make sure, is it the right time for you to invest or buy? Affordability, there's a lot more conversation around it so we can lend responsibly and buy responsibly. So every situation is going to be different, but what this all really means, I will recap that for you later on. The other crisis that led to our cyclical cycle is the most recent 2020 COVID-19.
The pandemic may be leading some people to leave San Francisco. The city chief economist says data shows more people have been moving out of the Bay Area to live and work elsewhere.
COVID-19 created a completely different kind of shock. Transactions paused, not because of leverage, not because of loss of jobs, but really because no one really knew what the city would look like after COVID-19. We all had to figure out where we would work, how we would work. And what came out of 2020 was remote work. People work from home. They no longer had to work where their offices were, because at that time, we all had to isolate from each other. So the remote work created a sense that the urban markets were over. What we really saw was not a massive abandonment of properties in San Francisco. There was hesitation and uncertainty. People waited, rightfully so. Some segments of the San Francisco market softened. People's buying behaviors did change because what they had realized is that if I had to work from home, I'm also allowed to work further away from home. People started to change their buying patterns. They bought a little further from San Francisco. They appreciated a little larger lot, more outdoor space to accommodate their different lifestyle. Couple that with the interest rate that drastically dropped at that time, people that worked realized their affordability grew. So that led to the outskirts of San Francisco prices go up. And slowly, people did come back to San Francisco and prices rebound higher than ever. So what's the pattern? To sum it all up, across all these cycles, these major cycles that we still remember, the real story is not drastic price movements. It's rather cyclical. It's buyers' behavior is geologically what's happening and what their needs are. Buyers delay when their future is unclear, even if they're long-term thinkers. Sellers under certain time pressures prioritize certainty over maximizing their price. Transaction volumes drop before fundamentals actually shift. In San Francisco, the limited supply means fear shows up as volatility and pauses, not years of excess inventory. And that's why downturns often feel dramatic and then resolves itself eventually, neighborhood by neighborhood. Disruptions in the market ultimately affects people's timing. It affects negotiations. It affects psychology. but it rarely resets the city itself. Just looking back and remembering these past fear cycles, let's not pretend that they weren't painful, because they were. But it's also about understanding whether today's headlines point to temporary disruption or a true structural fundamental change. And that distinction matters a lot, whether you're deciding to wait, act, sell, or buy or invest. And what's the big takeaway here? Well, in my opinion, San Francisco Bay Area real estate has a long history of reacting during moments of fear. But in general, we rebound faster than what most people may expect. And when it happens very quickly. And the people who won each time these cycles happened, they were not trying to time it exactly to reach the bottom or the top. They made money along the way. They understood that these changes, if you believe in the San Francisco Bay Area itself, rebounds quickly. And we've shown to be rather resilient. And what we've also seen is the trend, is the pricing trend. Every time we had a major event that instilled fear, we dipped in price, we rebound stronger. Every time we dipped in price because of a big financial event, we stay there and then we rebound stronger. And then every time we dip a little, we rebound stronger. So a lot of times when you look back at the 10-year trends of real estate every given time and place, the best time to buy was 10 years ago. And those gaps are getting shorter and shorter. I can evaluate each and every one of these neighborhoods and counties with you, and we can take a look. I love numbers. If you love numbers, I'm here for you. And if you would like more context like this, please give me a call, text me, or DM below and let me know what you'd like to know about. And more importantly, if you'd like to know what today's market is compared to these past cycles and what that means for your situation exactly, well, you have to give me a call or contact me. My information is just below.